Hello everyone, here is Gemini AR. And just so you know, this explainer was prepared by Dr. Samir Al-Rishani with some help from AI. All right, today we are diving into one of the most powerful tools in finance, the statement of cash flows. Seriously, this isn't just about crunching numbers. It's about becoming a detective and following the money to see what's really going on inside a company. But let me kick things off with a question for you. Think about this. Can a company be posting huge profits, looking great on paper, and still go completely bankrupt? It sounds kind of crazy, right? A total paradox. But the answer is a definite 100% yes. And here's the absolute key to understanding why. Profit is not the same thing as cash, not even close. You see, a company can say it made a profit the second it sends a bill to a customer. But that's just an IOU. The cash isn't actually in the bank yet. So you can totally have a business that looks incredibly successful, but its bank account is running on fumes.
So, how do we get to the truth? How do we solve this mystery? Well, we bring in our #1 investigator, the statement of cash flows. You really should think of it like a financial detective. It couldn't care less about accounting theories or promises of future payment. It has one mission: to track where every single dollar came from and where every single dollar went. Period.
And that brings us to the core lesson here. Profit isn't always cash. The statement of cash flows is the one tool that cuts right through all that accounting jargon and just shows you the cold, hard truth of a company's ability to actually generate and spend real money.
So why should you care about this so much? Well, for a few huge reasons. First, it tells you if the main business itself is actually making money or just burning through it. Second, you get to see the big strategic moves, how the company is investing in itself and where it's getting its funding. Third, and this is huge, it helps you predict what the future cash flow might look like. And finally, it gives you a way to compare two different companies on an apples-to-apples basis. It's the great equalizer.
Now, the statement tells this whole cash story in 3 main chapters. And the first one is the engine room of the company. It's what I call the daily grind, the cash that comes from its core operations. So, operating activities. This is all about the day-in, day-out business. You know, the cash flowing in from actually selling your products or services to customers. And of course, the cash flowing out to pay for things like supplies, rent, employee salaries, and taxes. This section answers the most basic question of all. Is this company's core business a cash machine or a cash drain? Okay, so we've got the daily grind covered. Now let's zoom out a bit and look at the big strategic moves a company makes. This next part of the story is all about how a company invests in its future and how it gets the money to fund those big plans. First up, we've got investing activities. This section is all about the long-term game. It's where you see a company spending cash on big-ticket items that are meant to help it grow, like buying a new building, new machinery, or even buying another company outright. Now, on the flip side, if you see cash coming in from investing, it means the company is selling off those kinds of assets. So it tells you right away if a company is expanding or maybe tightening its belt.
And then there are the financing activities. This is basically the story of where the company gets its money, its capital. Did it sell stock to new investors to raise cash? Did it take out a big loan from the bank? You'll see that here. You'll also see how it gives money back, things like paying dividends to its shareholders or paying back the money it borrowed. For a young startup, you'd expect to see a lot of cash coming in here, while an older, more established company might be using its cash to pay down debt.
So there you have it, the 3 essential pieces of our cash puzzle: operations, investing, and financing. Each one tells a really different but equally important part of the financial story. So now, let's put them all together and see the complete picture.
And building this statement is actually a pretty logical process. You don't just throw numbers around. You start by figuring out the net cash from the day-to-day operations. Then, you look at the big investing moves. After that, you add in all the financing activity. And finally, you put it all together to get the complete story for that time period. 1, 2, 3, 4. And here it is. This is what the final report looks like. You can clearly see the 3 main sections we just walked through. You just take the number from each section, add them all up, and that gives you the total change in cash. You add that number to whatever cash the company started with, and boom, you get your ending cash balance. That's the real bottom line.
Now here's a little twist for you. When it comes to that first section, operating activities, there are actually 2 different ways to calculate it. The most common way is called the indirect method. It's a bit weird. It starts with net income and then works backwards, adding and subtracting things to get to the true cash amount. The other way, the direct method, is way more intuitive. It just lists cash received and cash paid. They look totally different, but here's the kicker. They're just 2 different roads that lead to the exact same place.
The final number is always the same.
Okay, so you might be wondering, what about big transactions where no cash actually changes hands? I mean, what if a company buys a whole building just by trading its own stock for it? Great question. Those are called non-cash activities, and because no cash moved, they don't show up on the statement itself. But they're still super important for understanding the business, so companies have to list them separately, usually in the footnotes. This way, you still get the full story.
You know, I think this quote just says it all. At the end of the day, accounting can get really complicated with all sorts of rules and estimates. But cash is simple. It's real. The statement of cash flows really does tell the story in the most direct, honest language there is, the language of cash.
So the next time you're looking at a company, I want you to remember that riddle we started with. Don't let yourself get dazzled by a big profit number. You've got to follow the money. Now that you know how to read the real cash story, what are you going to discover? What truths are hiding just below the surface, waiting for a good detective like you to find them?